Hello and welcome back to Dukascopy TV. Today we're talking European equities. In the studio today is Mourtaza Asad-Syed, who is the Deputy CIO at Societe Generale Private Banking, Suisse. Welcome to the studio, Mourtaza.
Hi.
Now, let me just ask you as a sort of open question, where would you invest right now?
We would consider European equities. Surprisingly, the issue in the region with the most problem is for us the most attractive in the sense of valuation, especially on the long-term prospects for investments. We think for clients with a long time horizon, we think here is really a nice opportunities located in European equities.
But why particularly Europe?
In fact, Europe has went to so much trouble, Europe was so much disliked by investors that it turns to be really, really cheap. And what we consider as the most important variable in terms of long-term investing is valuation, not growth. So growth has been a poor predictor of future performance on the equity side, and we consider valuation, especially right now, let's say cyclically adjusted valuation, and we see it on all metrics, price to book, price earnings, even dividend yield. European market is the most attractive in the OECD.
And where in particular would you invest in Europe?
We have a very diversified approach because we have cheapness in Italy and Spain, but we have a lot of weaknesses in potential dividend cuts. And we have quality companies in, let's say, Northern Europe with more stable business model, but usually they're more expensive. But in the end, if you diversify properly, you find out that there is also quality companies in Italy or in the French market, for instance, or even in the UK market. And in fact, there is also cheap companies in Switzerland or even in Germany. So in the end, I would not take a sector in particular, especially with a 3 or 5 year time horizon. But I think the criteria of bias, if you want, in investing in European equities would be quality. Looking at a company with stable dividends in the past, but especially very high credit ratings. Because you know those companies will go through the trouble over the next 2 years, because we know there might be issues still pending, and those companies with very strong balance sheet will grow through and will be the winner and in the end of the troubling period.
Now, why equities in Europe as opposed to, say, Japan or US, for instance?
There's two main differences. There's in European equities in terms of investing. One, it would be comparing to the US. Clearly, the US seems more attractive because US has more engine for growth. Especially we are betting on the reindustrialization of the US with sort of new energy or cheap energy coming in their economy and fueling a higher growth in the US than in Europe. But in the end, we see that it's already discounted in the US market. What is not discounted in European market is at least that growth will be stable, not declining. So we think that with different growth prospects, in fact, Europe would needs to deliver much less to be a winner than compared to the US. The second perspective on European equities is comparing to Japan, which is fascinating. Japan has had a bear market of like 25 years with a big issue of growth. And the parallel between Europe and Japan have been very striking, and this is where we think investor, let's say the consensus might make a mistake, is to think that Europe will follow Japanese scenario. In terms of economics, it's very close. Growth is not very attractive in the medium term. Demographics are unfavorable. The real estate market might be a little bit going sideways. And finally, we know the financial system is pretty much clogged like the Japanese system. But the big difference is the starting point of the Japanese crisis. Being 92, 95, or even 2002 has never been as cheap as the European market today. So now we see Japan took 25 years to converge to a, let's say, fair value or attractive valuation. It took only 5 years in Europe. So since the crisis in 2007, European valuation from a, let's say, P standpoint is about 10 to 12 times. This has not been seen in Japan between 1985 to 2007. Never.
Okay.
Was the Japanese equity market so cheap.
All right, so you've sold it to me that I should go for sort of European stocks over US, Japanese. If I was an investor, though, I know that there are some risks here. What are the main risks?
The risks are on the short term. What will happen in Europe over the next 6 to 12 months? How Spanish government and Spanish private sector are going to deleverage themselves smoothly. This is not the done deal. We expect Spain at a certain point to ask for help and to get some help, especially from the ECB. But this might not be so smooth. It might come with more stress in the market, as it often happened in the past. The ECB, or let's say the cavalry, came after a stress in the market, like the LTRO 1 year ago. This could well happen in 2013. We could have, let's say, gaps in the market and stress time. And we don't discard it. We don't say Europe is cheap and buy it blindfoldly. We say Europe is cheap, there is reasons, those issues are still pending, might bring volatility. Surely it will bring volatility, might be nice entry points during a year, but in the end that's where you will make money, is buying in stressful time when everybody is scared. What I would add is that there is so much fear in the market. Valuation is cheap, but there is sort of complacency also because of the central bank intervening. Volatility is low. So the nice trade-off, the nice combination is in fact to take cheap volatility and to get exposed to a cheap market. So options and optional strategy on European equity market seems to be really the best way to go about mitigating risk on the short-term basis and taking advantage of long-term returns.
Okay, Mourtaza, thank you very much for giving us a little insight into your investment strategy. I've got something to show you though on the back screen, which is our Dukascopy questions. So still with your investment choice in mind, we've got a selection of asset classes: real estate, equity, bonds, gold, cash and oil. If I was to chuck $1 million at you now, where would you invest it?
Can I take it in my pocket, 1 million?
You could take 1 million, but firstly you'd have to select one of these and then you could go off and spend it.
So the one that will really fit in my pocket would be gold.
Gold.
We think it could be the best asset for the year. It would be a record-breaking streak, 13 years of bull market, but it will still think that on a short-term basis, let's say 3 to 12 months, risks are still there. And if the cavalry comes, it will come into the term of central bank intervention. And this is always good for gold. And then we'll switch to European equities.
Mourtaza, thank you very much for coming into the studio today. That's all we've got time for on Dukascopy TV for the moment, though. Stay with us throughout the day and, of course, for the rest of the week as we bring you further interviews and updates. But until next time, goodbye.